is down more than 4% after the International Energy Agency said it's releasing a total of 60 million barrels from its reserves. Jason Schenker joins us now. He's a Bloomberg Best economist, president of Prestige Economics. He's live on the phone with us from Austin, Texas. Jason, obviously, energy traders seemingly in the red today, but ultimately, is this decline in oil a good thing for the broader economy?
Well, you know, I think for the broader economy, talking about what it means today is maybe less important than talking about what it means a couple of quarters from now or next year. The move today is actually really scary because this is one of the last things that we can do globally in order to push prices down. 2 weeks ago, Saudi Arabia made the unilateral decision at the OPEC meeting that I attended in Vienna to produce more oil in anticipation of potentially catastrophically high prices at the end of this year and next year. And now the IEA has stepped in to do the exact same thing. They're not doing it to push prices, as one analyst said, to 65 to 85. They're doing this to stave off massively higher prices and prevent a catastrophe at the end of the year or next year economically.
Right. Well, we had already heard from Morgan Stanley, from Goldman Sachs, that the second half of the year, we are going to see supply constraints. We are going to see the price of oil climb, even if right now we're at, in that $90 a barrel range. Is this fundamentally a reconsideration of the thesis that taking the Libyan oil supply off the market wasn't that much of a hurt? Was it worse than what we had originally forecast?
Well, it's not worse than what we'd originally forecast, but perhaps people were a bit too optimistic. I know our price forecasts for the back end of this year are also for rising prices. At the end of the day, the scariest factor you need to consider is we are in the second year of a global economic expansion. And with Saudi Arabia pledging to produce as much oil as needed, with the IEA opening up inventories, even though prices are down today, WTI is still floating around 90, Brent's still over 100. What will oil prices look like 1 or 2 years down the road from now when the global economy is expanding at an even faster pace?
So you believe that at the IEA, at the White House, they were seeing economic indicators that drove this? This wasn't a political decision. This was an economic one?
Well, no, I think it absolutely is an economic decision. I mean, at this point, we've heard conflicting things from Ben Bernanke in the last 2 weeks. 2 weeks ago, he says that the recovery is not yet confirmed. Yesterday, he shies away from the concept of a QE3. But this is something being done to ensure there are global oil supplies at the end of this year and next year to prevent a shortfall, which would be a major, major problem. I actually view this as something very, very bullish. After all, if oil prices were to go up now, what other options do we have? This is it. Both the oil markets are against the wall and the Fed is against the wall. What are they going to do? We're going to keep things accommodated for a very long period. What are their other options at this point? All they can do is more quantitative easing. But for the global oil market, there really isn't more you can even do.
Jason, very quickly, if this had happened yesterday, how would it have changed Bernanke's forecast?
Well, I don't necessarily think it would have changed his forecast. Again, this is being done with the intent of preventing further bad economic catastrophe. Much higher prices are being staved off by this. It's not being done necessarily to push prices lower.
All right, Jason, thank you very much for giving us your quick analysis.